Will bankruptcy save your home from foreclosure? It's a question millions of homeowners ask. Bankruptcy often seems like a lifeline, but it's complicated. There are serious long-term consequences. What if there are better options? The financial world has hidden solutions. Options to stop foreclosure time is your most valuable asset. I'll break it down step by step. We'll explore 5 strategies to stop or postpone a foreclosure. Option 5 is bankruptcy, but we'll save that for last. Please hit that like button. It helps the channel, so let's get into it. Alright, let's dive into the first and, in many ways, the simplest option, reinstating your loan. Think of this as hitting the reset button on your mortgage. Essentially, reinstatement means you pay the lender everything you owe in one lump sum to bring your loan completely current. This isn't just the missed monthly payments, it includes any and all late fees that have piled up, plus any legal or administrative costs the lender has incurred. It's a clean break from the default status, and once you've paid it, your loan goes back to normal, as if nothing ever happened. This is, without a doubt, the fastest and cleanest solution if you have access to the funds. There are no lengthy negotiations, no complicated paperwork changing the terms of your loan, and no lasting damage to your credit beyond the initial missed payments. The foreclosure process stops immediately upon the lender receiving the funds. It's the preferred method for banks because it's simple for them too. They don't want to own your house, they just want the money they are owed. So if you can come up with that cash, they are more than happy to put everything back on track. However, the big challenge here is pretty obvious. Coming up with a large sum of money on short notice. If you fell behind on your mortgage, it was likely because of a financial hardship like a job loss, a medical emergency, or an unexpected major expense. So suddenly having thousands of dollars available to catch up can seem impossible. This option is most realistic for someone who had a temporary setback. Maybe they were waiting on a commission check, a bonus, or an insurance payout that was delayed but has now come through. It's for the person who has resolved their short-term cash flow problem and now has the means to fix the situation completely. Before you even consider this, you need to get what's called a reinstatement quote from your lender. This is an official document that breaks down the exact amount of money you need to pay, item by item. The amount can change daily as interest accrues, so you need an up-to-the-minute figure. And let me be very clear, before you send a single dollar to the bank or make any agreements, it is absolutely critical that you consult with a qualified attorney or a housing counselor. They can review the quote, make sure all the charges are legitimate, and advise you on the best way to proceed. The reinstatement quote's total amount might be a lot higher than you expect. You'll see principal, interest, and late fees. That add up fast. The lender's legal and administrative fees also get tacked onto your debt. You'll also have to repay property tax or insurance payments. Get professional advice. An attorney or HUD-approved housing counselor can scrutinize the reinstatement quote, act as your advocate, and ensure you only pay what is fair. Don't make this decision alone. One of the most critical factors with reinstatement is the timeline. This is not an option that stays on the table forever. Most states have laws that give you a right to reinstate, but that right has an expiration date. Typically, you can reinstate your loan up until a certain number of days before the scheduled foreclosure auction date. Once you pass that deadline, the lender is no longer legally obligated to accept your lump sum payment and stop the foreclosure. They can choose to proceed with selling your home at auction, even if you suddenly show up with all the cash in hand. Time is literally of the essence. The moment you receive a notice of default, or any formal communication about foreclosure, the clock starts ticking. You need to contact your lender immediately to request that reinstatement quote. Don't wait, don't assume you have plenty of time. The process of getting the quote, having it reviewed by an attorney, and then gathering the funds can take weeks. If you procrastinate, you could easily miss your window of opportunity. Every day of delay not only adds more interest and fees to your bill, but also pushes you closer to the point of no return, where reinstatement is no longer an option. Think of it this way: the further along the foreclosure process gets, the more expensive and complicated it becomes for the lender. As they spend more on legal fees and get closer to the auction date, their willingness to work with you on simpler solutions may decrease. They've invested time and money into the foreclosure path, and it becomes harder to change course. By acting early, you catch them at a stage where reinstatement is still a simple, clean transaction for them. It saves them the hassle and uncertainty of an auction, so they are generally much more receptive to it in the early stages. So, what's the key takeaway here? If you think reinstatement might be a viable path for you, if you have a way to access the necessary funds, You must act with extreme urgency. Your very first call should be to your lender to request the quote and to a foreclosure attorney or housing counselor to get professional guidance. Don't let fear or embarrassment cause you to delay. This is a business transaction, and treating it with immediate, focused attention is what will give you the best possible chance of keeping your home and putting this entire nightmare behind you. This is your moment to take control of the situation. So what if you can't come up with a giant pile of cash to reinstate the loan? For many people in this situation, that's just not realistic. This brings us to our second option, a loan modification. This is a completely different strategy. Instead of paying a lump sum to catch up, a loan modification permanently changes the original terms of your mortgage to make your monthly payments more affordable. It's not a new loan, but rather an adjustment, a modification of your existing one. This can be an incredibly powerful tool for homeowners who have experienced a long-term reduction in their income but are now stable and can afford a reasonable payment. There are a few primary ways a lender can modify your loan to help you out. The most common method is to lower your interest rate. If you got your mortgage when rates were high, a reduction of even 1 or 2% could shave hundreds of dollars off your monthly payment, making it much more manageable. Another strategy is to extend the term of the loan. For example, if you have 23 years left on a 30-year mortgage, the lender might re-extend the term back out to 30 or even 40 years. This spreads the remaining balance over a longer period, which in turn lowers each individual payment. A third, and often very impactful method, is principal forbearance or deferment. This is where the lender takes a portion of what you owe and sets it aside. You don't have to pay interest on this deferred amount, and it doesn't have to be paid back until the very end of the loan. This directly reduces the balance used to calculate your monthly payment, leading to significant savings. Often, a modification will use a combination of all three of these strategies to get the payment down to an affordable level. It's crucial to understand that a loan modification is a negotiation. The lender is not required to give you one, but it is often in their best interest to do so. Foreclosure is an expensive and lengthy process for them, and they would much rather have a performing loan than a vacant property they have to sell. The goal is to present your case in a way that shows them you are a good candidate, you had a legitimate hardship, that hardship is now over, and you have a stable income to support the new, lower payment. It's about proving you can be a reliable borrower again. Getting approved for a loan modification isn't automatic. The bank is going to put your finances under a microscope, because they need to be convinced that you can actually afford the new modified payment for the long haul. They are not in the business of charity, they are making a calculated business decision. The single most important factor they look at is your current stable and verifiable income. They want to see pay stubs, bank statements, tax returns, whatever it takes to prove that you have a consistent stream of money coming in every single month. A temporary gig or a one-time payment won't cut it. The magic number that many lenders look for is a debt-to-income ratio, specifically, a housing-to-income ratio. They generally want to see that your new proposed mortgage payment, including taxes and insurance, will be no more than about 31% of your gross monthly income. So if you make $6,000 a month before taxes, they're looking to structure a new payment that is right around $1,860. If your income can't support a payment in that range, even with the best modification terms, your application will likely be denied. They need to believe the solution is sustainable. This means you have to prepare a detailed financial package for the lender. This is often called a request for mortgage assistance, or RMA. It includes a hardship letter explaining why you fell behind and why the situation is now resolved. For example, I was laid off from my job, but I have now been employed full-time for the past 4 months at my new job. You'll also need to provide a detailed breakdown of your monthly household budget, listing all your income sources and all your expenses, from car payments to groceries to utility bills. Honesty and thoroughness are absolutely key here. Remember, the lender's goal is to avoid another default. They are taking a risk by modifying your loan, and they want to mitigate that risk as much as possible. They are essentially asking themselves, if we do this for the homeowner, what is the probability that they will just fall behind again in 6 months? Your application needs to answer that question for them with a resounding very low. You need to paint a clear picture of financial stability. If your income is inconsistent or not quite high enough, You may need to look at reducing other debts or even picking up a part-time job before you apply to make your financial profile look stronger. The loan modification process can be long and frustrating. It can take 30 to 90 days, and the foreclosure process is often paused. This is a marathon, not a sprint. Stay organized, keep copies, and follow up relentlessly. Professional help can be invaluable. An expert can dramatically increase your chances of success. This is for informational purposes only. Consult with a qualified attorney or a HUD-approved housing counselor. Don't navigate this alone. Get expert guidance. Let's explore selling your home. Acting early is key to maximizing your property's value. Strategic selling, not a fire sale, can get you a fair price quickly. Foreclosure can wipe out your equity, so take control by choosing to sell. We'll break down fast cash and concierge sales, preserving equity, and setting you up for a stronger financial future. Let's talk about the fast cash sale. A buyer makes an all-cash offer for your property, closing in as little as 7 to 21 days. Reputable cash buyers make fair offers based on market value, minus repairs. You typically sell as is, saving time and money on repairs. This is ideal for those near auction or with properties needing significant repairs. It offers a quick exit, stopping foreclosure and allowing you to retain equity. Now let's look at the second option, a concierge sale. This is a fantastic choice if you have a little more time to work with. With a concierge sale, a partner company essentially steps in to manage the entire sale process for you. They will cover all the upfront costs associated with getting the home ready for the market. The concierge service will assess your property and determine what minor repairs or cosmetic improvements could significantly increase its market value. The incredible part is that they will often front the money for these improvements. You get the financial benefit of selling a market-ready home without having to come up with the cash to get it there. This option is perfect for homeowners whose properties are in decent overall condition but could use a little TLC to really shine. The concierge sale can be the absolute best way to maximize your financial outcome. Let's explore a solution your bank might not tell you about, a subject to transaction. This means we, KarmaExit, take over your property and mortgage payments. The loan stays in your name, but we make the payments. This lifts the burden of foreclosure. We cure the default, stopping the foreclosure process. The property title transfers to us through a standard closing. This protects your credit report. Subject to transactions are faster than traditional sales, offering a quick exit, often with cash in your pocket. If we're talking about having a loan stay in your name while someone else owns the property, the first thing that probably pops into your head is, how am I protected? This is the most important part of the entire arrangement, and it's something we take incredibly seriously. It's a legally binding contract that is reviewed and executed by real estate attorneys. If we were to miss a single payment, this agreement gives you the legal right to take the property back immediately. You will have the ability to verify that the mortgage payments are being made on time every month. A subject to deal, when done correctly with all the legal safeguards in place, allows you to step away from an impossible situation cleanly. A subject to transaction isn't for everyone, but it's ideal for specific scenarios. This works best for homeowners with little to no equity. The goal is debt relief and credit protection, stopping financial bleeding and avoiding foreclosure. It solves the immediate problem, the unaffordable monthly payment. It's also great for those needing a quick, certain move due to job loss or other life events. A subject to transaction removes uncertainty. We offer a firm yes and a clear timeline. If you need to avoid foreclosure, protect your credit, and exit quickly, explore a subject to sale. It allows you to move forward with a clean slate. Let's discuss bankruptcy, often seen as a last resort. Filing for Chapter 7 or 13 triggers an automatic stay, halting foreclosure and collections. It's a temporary pause, not a permanent fix. Lenders will always request the stay be lifted. They always win at the end. Use this time to plan. Bankruptcy is a tool, not a magic wand. Consult a bankruptcy attorney first. When considering bankruptcy, Chapter 13 and Chapter 7 are common options. They differ, especially regarding your home. Chapter 13, a wage earner's plan, helps individuals with regular income catch up on debts. If you want to keep your house, Chapter 13 is often the better path. Chapter 7 aims to quickly wipe out unsecured debts. It doesn't offer a mechanism to catch up on mortgage payments. Chapter 7 is generally used to eliminate debt, but almost always results in losing the property. We have to be brutally honest about the downsides of bankruptcy, because they are significant and long-lasting. This is not a decision to be taken lightly. First and foremost, Filing for bankruptcy will have a severe negative impact on your credit score. A Chapter 13 bankruptcy remains on your credit report for 7 years from the filing date, while a Chapter 7 stays on there for a full 10 years. This is a very long time. During this period you will find it extremely difficult, and in many cases impossible, to get new credit at reasonable interest rates. Getting a new mortgage, a car loan, or even a simple credit card will become a major challenge. This credit impact is far more severe and prolonged than many other negative events. While a foreclosure is also very damaging, a bankruptcy is often seen by lenders as a more fundamental failure to manage financial obligations. It signals a level of financial distress that makes future creditors extremely wary. You're essentially resetting your financial life, but you're doing it with a major red flag on your record that will follow you for the better part of a decade. Rebuilding your credit after bankruptcy is a slow, methodical process that requires years of perfect financial behavior just to get back to a decent score. Beyond the credit damage, the bankruptcy process itself is public, intrusive, and stressful. It's not a private matter between you and your lender. Your filing becomes a public record. You will have to disclose all of your assets, all of your debts, your income, and your monthly expenses to the court, the trustee, and your creditors. This means laying your entire financial life bare for scrutiny. You'll have to attend meetings, answer questions under oath, and comply with the strict rules of the bankruptcy court. It's a demanding and often emotionally draining process that can take a significant toll on you and your family. This is why bankruptcy should truly be considered the option of last resort. It's a powerful tool, yes, but it's a tool that comes with immense costs. It should only be pursued after you have exhausted all other possibilities: reinstatement, modification, a pre-foreclosure sale, or a creative solution like Subject to. And it should never ever be done without the guidance of an experienced bankruptcy attorney. They are the only ones who can properly advise you on whether the temporary protection it offers is worth the long-term financial consequences you will inevitably face. It is a serious, life-altering financial decision. It can feel overwhelming, but you have options. You are not powerless. The worst thing you can do is nothing. At KarmaExit, we're here to help you understand your options, protect your home and financial future, and help you walk away with peace of mind. Visit us at KarmaExit.com to learn more and schedule a free consultation call, or email us at hello@KarmaExit.com. We genuinely want to help you find a dignified solution. Let's talk, we'll listen, and together we'll help you make the best decision for you and your family. You don't have to go through this alone.